Hello traders, in today's session we're diving into one of the most essential concepts that every profitable trader must master. Market structure. Once you fully grasp market structure, your entries, exits, and stop-loss placements will start to make perfect sense. But the truth is, many traders misread the structure and repeatedly end up taking losses. In this video, we'll go step by step from the fundamentals all the way to the advanced concepts, including what market structure actually is, how to mark different market phases, identify breaks of structure and changes in character, recognize strong highs and strong lows, and understand how internal and external structures develop. Let's dive in, but before we continue, if you find value in this content, hit that like button, and if you're new to the channel, don't forget to subscribe and turn on notifications so you never miss our future uploads. I'll catch you right after the intro and disclaimer. So, first, let's understand what market structure actually means. Market structure represents the direction of price movement, the pattern of highs and lows forming, and who's currently dominating that movement. Buyers or sellers. The market generally moves in three primary phases: an uptrend, a downtrend, and a sideways market. During an uptrend, prices create a series of higher highs and higher lows, showing that buyers are in control. The price keeps climbing, and every time it pulls back, it stays above the previous low. When it rises again, it sets a new high. This repeating behavior confirms that the market is trending upward. In a downtrend, prices form lower lows and lower highs, signaling that sellers are leading the market. The price keeps declining, and each upward correction stays below the previous high. When it falls again, it prints a new low. This consistent movement confirms that the market is in a downtrend, sideways or consolidation market. In a consolidation or sideways phase, the price trades within a confined range. It doesn't clearly move upward or downward, showing that buyers and sellers are evenly matched. During this stage, there's no defined trend. Price fluctuates within a narrow zone, and the market remains indecisive. This stage often precedes a major breakout or breakdown. Therefore, patience is key until the market shows a clear direction. These three phases repeat again and again, forming a continuous cycle in the market. This fundamental understanding of market structure is the basis of price action. When we shift to the smart money concept, SMC, perspective, structure analysis becomes more precise. Simply identifying highs and lows is not sufficient in SMC. We must go deeper into two crucial concepts. First, a break of structure occurs when the market continues in the direction of its previous trend. This confirms that the existing trend remains intact. Second, a change of character happens when the market gives the first strong clue of a possible trend reversal. It serves as an early warning that momentum might be shifting. Now, let's move on to understanding the concept of a break of structure. A break of structure, also known as a BOS, occurs when the price breaks through its previous structure. This indicates that the market is confirming its direction by violating a significant swing high or swing low. When the market is in an uptrend, price action consistently forms higher highs and higher lows. But when the price surpasses its previous swing high, that moment is referred to as a break of structure or BOS. This signifies that the market has formed a new bullish structure. The previous high is taken out, and a new high is established, showing that buyers are in control and the uptrend remains intact. Conversely, in a downtrend, the price creates lower lows and lower highs. When the price breaks below its previous swing low, that event also represents a break of structure. This means the market has established a new bearish structure. The prior low has been broken, and a fresh lower low has formed, indicating that sellers dominate and the downtrend continues. After understanding the break of structure, let's move to the second key concept in the smart money concept: the change of character. Imagine the market is in a strong uptrend, where price continuously makes higher highs and higher lows. After every pullback, it creates a new high. But then, a moment arrives when price fails to break its most recent swing high and instead closes below the previous swing low. This marks a major shift. It means the market, which had been showing bullish behavior and consistent buying pressure, is now losing strength. The structure breaks down, and bearish momentum starts appearing for the first time. This reversal in direction is what the smart money concept defines as a change of character. Simply put, when the market transitions from a bullish to a bearish structure, or from a bearish to a bullish one, making its first valid move in the opposite direction, that transition is known as a change of character. Now, let's move on to how we can identify a change of character on the chart. We can observe that the price first forms higher highs and higher lows, but eventually breaks a swing low that had remained intact throughout the trend. This movement serves as the first signal of a potential trend reversal, known as a change of character. If, after forming a peak, the price creates a lower high and then breaks that same swing low again, it represents a bearish break of structure. This confirms that a bearish structure is now active in the market. A change of character should always be viewed as an early trend reversal alert. When this signal appears on the chart, it indicates that the previous trend has weakened and the market may be preparing to move in a new direction. You can plan your entry setups around the recent peak, especially if price makes a solid retracement afterward. Such pullbacks often create a clear entry zone, where you can position yourself at the fair value gap or the order block for optimal entries. Now comes an important question. Which break of structure or change of character is valid, and which one is a trap or false signal? When the price decisively breaks the previous swing high with a strong candle body close, it's considered a valid break of structure. This confirms that the structure has been broken. However, if price only taps a weak level and immediately reverses, that's a fake out, which counts as an invalid boss. Similarly, when price closes below the previous swing low and a trend reversal begins, it's a valid change of character. But if a sharp reversal occurs after just a weak break or a brief close, that's a false signal, and we treat it as an invalid CHOCH. The key rule to remember is, no top or bottom is valid without a candle body close. Next, let's address another common question. Is this pullback valid or fake? The answer lies in the Fibonacci retracement tool. In a bullish market, we draw the Fibonacci retracement from the bottom to the top. If price retraces to the 0.50 or 0.61 level and then bounces upward, it's considered a valid pullback. When price breaks the previous high following this valid pullback, we can confidently mark it as a break of structure. So, to accurately identify boss and market peaks, remember this: do not shift your structure based on a weak breakout, and do not treat a shallow pullback as valid confirmation. Structure mapping can become unreliable unless it's supported by a clear candle close or a deep pullback. Now, let's move on to understanding how to identify strong highs and strong lows. When the market transitions from bullish to bearish, the last swing high formed just before the peak is identified as a strong high. Stop losses are often placed above this level, and smart money uses this zone as resistance in future trades. When price forms a new lower low, the following lower high created after that low also becomes a strong high, as long as the market continues to respect the bearish structure. On the other hand, when the market shifts from bearish to bullish, the last swing low formed before the reversal is considered a strong low. This is where buyers' stop losses are hidden, and smart money treats this area as support in future trades. When the price then creates a new higher high, the next higher low becomes a strong low, as long as the bullish structure remains intact. Now, let's move on to understanding internal and external swings. When price pulls back after a breakout or strong move upward, two types of swings form in the market: external swings and internal swings. Let's start with external swings. External swings define the major structure of the market. For example, higher highs and higher lows during an uptrend, or lower lows and lower highs during a downtrend. These swings form the core framework of market structure, and major moves such as rallies and declines are identified through them. Now, let's understand internal swings. Internal swings develop within the retracement phase. After a strong move, when the price trades between the previous external swing highs and lows, the smaller movements inside that range are called internal or minor swings. These zones often become trap areas for smart money. Smart money uses these internal swings to trigger breakouts, attract retail buyers or sellers, and then hunt their stop losses. When the price pulls back after a major move, we shouldn't jump into a trade immediately. Instead, wait for confirmation signals, such as an order block or a fair value gap, before entering. So remember, smart money trading revolves around identifying breaks of structure, changes of character, and understanding strong highs. strong lows, and structure shifts. That's it, traders. Thanks for watching this video. Nothing around you changes until you decide to. Most people wait for the right moment, but winners create it. If this video gave you even a single reason to think differently, go ahead and hit that like button. And if you're new here, make sure to subscribe and turn on the notification bell, because every upload is designed to help you grow sharper, smarter, and more focused. Keep moving forward when everyone else slows down. That's where real growth begins. Stay focused, stay disciplined, and I'll see you in the next video.